Please give a warm welcome to the Director of Education at the Merriman Education Foundation, Chris Pedersen. Chris.
Thank you, Tom. And I've asked Daryl to come up just for a minute. Those of you who have followed Paul's work know that Daryl does it. He creates all of the tables that I'm going to go through, and I just wanted to have you guys have the chance to thank him for his work. So, thanks, Daryl. It's great. So today we're going to talk about the meaning of diversification, and this presentation in and of itself is an example of diversification, which is combining two very different things. So we have Paul's slides and my presentation. We have never done this before. So we'll see how it goes. It'll be kind of fun. Paul and I have kind of different styles, but I think we come from the same spot. We both really like helping people. And we really like to help people with finance, which is just a fascinating puzzle. So this is a quote that he put in early, and I'm not honestly exactly sure what he wanted to do with it. It says, "Tell me and I forget, teach me and I may remember, involve me and I learn." And the thing that comes to mind for me from this quote is that 7 years ago, pretty much today, it was on the 9th, not the 8th, I attended here. And like many of you, I think I'd come to the point in life where I realized I'm going to have to live off the money that I've saved. I was right on the verge of retirement. I retired a few months later. I knew it was coming. I had no idea how to do it. I didn't know all the stuff Joe just talked about. And I was a little bit anxious. I was the involved student. And I hope you are too. I hope you're interested. I hope you're at a point in life where you're thinking, I kind of need to figure this out, and you want to pay attention. And we're going to give you some numbers and some history and some ideas that you can get involved with. And some of it's in your packets, your handout. You can go home and you can look at it later. So what do I want to teach today? Well, we're going to talk about diversification. So we're going to talk about a different way of thinking about diversification. And we're going to talk about how it reduces risk, how to increase diversification and return at the same time. Some of you know that you can diversify by investing in equities and bonds. We're not going to talk about that today. We're only going to talk about stocks or equities. If you combine equities and bonds, you get less volatility, and you still preserve a lot of the return. So that's an important way to diversify. But within stocks, within equities, you can do meaningful diversification, and we're going to focus on that. And we're going to show you how it can impact the return and the risk. And then we're going to talk about how to make it very, very simple. So it's going to sound complicated maybe in the middle, but you can do this with just 2 funds, and we'll get to a point where you can see how that works. So what have we been taught about diversification? Again, this is Paul's slide. So this is his history. It's him working as a stockbroker back in the 60s and then coming up through the ranks and learning over time. And when he started his career, and this would have been the time when my parents and grandparents were investing, 10 to 20 stocks in a portfolio was meaningful diversification. That was plenty. When mutual funds became available and ETFs became available, then we learned that, you could have more. You could have 100 stocks, not just in a stock portfolio, but you could have 100 stocks in an equity class, a particular subset of the universe. So that meant more diversification, more stocks. But we also learned that you could have 1,000 stock portfolio and you still wouldn't get rid of what's called market risk. So essentially what's happening as you go through these is that when you combine things that are similar but different, you get rid of what's called idiosyncratic risk. So if I invest in one company, I put all my money in one company, the expected return is going to be the same return I would get for other companies of that type. Let's say it's a technology company and the expected return is 12%. But there's a chance I get 0%, right? Because that company could go out of business. You don't know. There's a chance you could get 1,000%. You don't know. But if you combine all of the companies of that type together, you get the same expected return, but a much, much narrower range of outcomes because the probability of all of them going out of business is pretty close to zero. So that's why when you combine 1,000 stocks, you can get rid of some risk, but not all of it. You don't get rid of market risk. And diversification among these equity asset classes, and we're going to talk about what we mean by that in a minute, is very important. Actually, we're going to talk about that now. And I'm glad I got a laugh because I am not a comedian like some of the other people in front of you. So thank you. I appreciate it. So equity asset classes. This was the slide I would have put in that Paul doesn't have. If you go back to 1992, Fama and French published groundbreaking work in a paper called roughly the cross-section of equity asset returns. And what they did was they looked at the entire stock market and broke it into, you can think of it as 4 different corners, big and small, and then the companies in favor, which would be growth, and the companies that are out of favor, which would be value. So big company might be Facebook, Meta. They'd also be growth companies. They're companies that you know, that people are excited about. They think they're going to have this bright future. NVIDIA would be in there. Those are your really big growth companies. You can also have big companies that are out of favor. So maybe that's a Honeywell or a General Electric or General Motors. They're companies that they're big, but they're not priced as expensively because people aren't as excited about them. And then you have small companies, obviously a lot smaller. We probably don't know a lot of their names. And they can be growth, exciting companies, or they can be value companies as well. And so that set of divisions is really important because the things that are out of favor and the things that are small historically have delivered a higher return. And the things that are big and are in favor historically have delivered a smaller rate of return. And we can actually look at that. We'll zoom in on this. So you have this as a handout. You don't have to read it on the screen. And this is one of Daryl's masterpieces. And zooming in, it'll make a lot more sense. But we can look at these 4 categories. The S&P 500, which is large cap blend. That's a combination of the growth and the value. Small cap blend, I'm reading the top left-hand corner here, top to bottom. And then small cap value and large cap value. And then we have one other thing on this chart called the 4-fund combo, which is 25% of each of the others combined together. And they're color-coded, so you can look at the chart and you can kind of try and find a pattern. Does anybody see a pattern? I hear laughter, so it's kind of random, right? If there is a pattern, it's probably that the 4-fund combo spends a lot of time in the middle. That's about the only pattern, really, that you see. If we were to go back to 1928, though, and let's say we knew what Fama and French know. We'd been in a time machine, and we know in the future there's going to be these categories. There's going to be this paper published, and we want to know the winner. We don't know the paper. We just know that these categories are going to exist. We look at 1928, and you would say, wow, the S&P 500, 43.6% annual return for that year, and we could ignore everything else, right? We should just invest in the high-flying winners in 1928. But we know what came next. It wasn't a great time to be in the S&P 500. We'll go back to the 1928 data in a minute. We can take any one of these decades. We can go to 2014 to 2023, and we can look and say 10 years. That's a lot of history, right? So 1 year wasn't enough. What about 10? Let's look at 10 years of history. If you look at 10 years of history, starting in 2014, what you see is that the S&P 500 did 13.7%, so it was the best. In 2015, it did 1.4%. It was still the best. In 2016, a little bit of an off year for the S&P 500, down at 12%, but it's still a positive return, right? And then it leads the way, 2017, 18, 19, 20. Very good performance for the S&P 500. A couple of mixed years and another good one. This was a good decade for the S&P 500. It was, and we're living through that right now. We're on the other end of a time period when a lot of people say, why would you do anything else? Why not just be in the S&P 500? But we can actually look at this with just a little bit more insight and learn something really important. Let's go back to 2014. What are the two things that are at the top? The S&P 500, which is large and blend, and large cap value. So what's doing well in 2014? Large, right? Big things are doing well, whether they're value or blend. Let's look at 2015, still large. 2016, small cap value and small cap blend. What changed? I don't actually know off the top of my head, but something changed, right? It may have been fiscal policy, it could have been the cycle of the economy, it could have been interest rates. There's all kinds of things that change that drive the valuation and the stock prices of companies, and they don't react the same. They react differently depending on these attributes. So again, 2017, it's large. 2018, we'll call it large. 2019, it's large. 2020, that's kind of interesting. S&P 500 and small cap blend. S&P 500 is large cap blend, so what's doing well there is blend. So there is a pattern, and the pattern changes, and it changes with a little bit of human behavior and emotion and a lot of financial science, as Joe described it earlier. So that was one decade. We could also go back to the 1998 to 2007 timeframe, and what we see in that timeframe is actually quite a different picture. And I believe this is a time frame when Paul's business was coming up. And this was a very good time for him. Because what you see is that small cap value had an amazing decade. 2000 to 2004, small cap value was at the top with very high returns. 2005 was still good for value. 2006, small cap value. So if you were an advisor in this period of time teaching people that maybe they should do something beyond just the S&P 500, you were rewarded for it. And if you were an investor who followed that advice, you were rewarded for it handsomely. But what we saw in that previous chart is that there are periods of time when you have to wait very patiently. To get to a different destination, you have to take a different journey. And that different journey requires patience, perseverance, persistence, understanding, knowledge of this kind of a history that teaches you that it's worth the wait. So what have we learned from these results? First of all, the returns are random. A decade isn't long enough to really draw long-term conclusions about what is going to deliver the highest return. Second, size, value, and growth drive the winners and losers. And that's not just some magic box that produces some mystical answer over time. It's driven by economics. It's driven by business fundamentals. It's driven by the value of a company's future earnings discounted by the rate of inflation or the perceived rate that it should be discounted by. Advantages and disadvantages can also go on for a very long time. A decade on this chart looks like a short period of time, but how long is a decade when you're lagging the market? It's a long time, right? It's a very long time. And it can go on for longer than a decade. It can go on for 2 decades. So it really is important to have good behavior if you want to invest in these different ways. If you want to be excited and happy when your neighbor is excited and happy because the S&P 500 is up, and you're also going to be satisfied being sad and depressed when your neighbor is sad and depressed because the S&P 500 is down, then you should invest in the S&P 500. If you want to go to a different place, though, then maybe it behooves you to diversify, right? To add some of this diversification. But the other thing we saw is that the 4-fund combo was incredibly stable in those charts. It was right through the middle. And Daryl did something really, really cool to analyze this, to take all of that entire chart and distill it down to one chart with some meaningful conclusions. And we'll start at the bottom. At the very bottom, you have the S&P 500. And what's really interesting about the S&P 500 as an investment, when you look at it in this history, is that it's kind of schizophrenic, right? It's a little Jekyll and Hyde. You spend a fair amount of time in quintile 1, that's the top of the chart, so that's the highest return for a period of time. But you also spend a lot of time in the bottom quintile of the chart. So 28%, it's the best, 41%, it's the worst, and only 31% of the time was it anywhere in the middle. So it's really hot and cold, right? If we go up the chart to US large cap value, what you see is that it doesn't sound like a portfolio, right? It doesn't sound like it should be diversified. But the large cap value investment was 66% of the time in those middle three categories. How can that be? How can it be that something that is a subset of the market more consistently delivered returns than the S&P 500? And the answer is, it goes back to what the academics discovered. It actually gives you exposure to more risk factors. So the S&P 500, all you get is market risk. That's it. If you invest in the total market, same thing. All you get is market risk. You'll run into people who say, why don't I just buy the entire market? Then I've got small, I've got value, I've got growth, I've got blend, I got it all. But when you do that, the growth offsets the value and the large offsets the small, and you actually don't get exposure to anything other than the total market. So the US large cap value gives you exposure to value and market risk. So in a sense, it is more diversified. And if you go up one step higher on the chart to the US 4 fund, which is this 25% combination of the four things, you spent 100% of your time in the middle three squares. You're never the best, you're never the worst, but you've got very consistent delivery of a very respectable return. In fact, the compound annual growth rate for the US 4 fund was 11.8%, where the S&P 500 was only 10%. It is a little bit more volatile in a statistical standpoint. So we'll look at some metrics, but some of that volatility is actually on the upside. So some of the ways that you might measure risk aren't necessarily the way that you really care about risk. And the way I think of this from a retiree standpoint is, what is my number one concern? When I retired 7 years ago after attending Retiremeet, my number one concern was, are we going to run out of money? Right? And in fact, I remember we'd been retired about 6 months, and my wife came to me and she said, where's the money coming from? You don't get a paycheck anymore. You're just like, how is this going to work? And it took a while to get comfortable with the idea that we were going to pay ourselves a paycheck out of our investments. And now, we're veterans. We're 7 years into it, and we're totally chill, and it's good. Life is good. But it took a long time to get there. And the US 4 fund is like an all-terrain vehicle. The fact that it so consistently delivers the returns that it delivers means that it's going to have a higher safe withdrawal rate than any one of these asset classes on their own, or than the S&P 500 on its own. And that means you're more resilient to the sequence of returns risk. So it's really, really a powerful tool for somebody in retirement. We can go farther up the chart, but what you see is you go farther up the chart with US small cap value and US small cap blend and US small cap value is you get higher returns, but now you're getting wider dispersion of those returns again. So small cap value is just as distributed wide as the S&P 500 is. You spend as much time in the endpoints with the small cap value as you do with the S&P 500. And that kind of begs a question. Like, you could implement this US 4 fund solution with just 4 funds. That's pretty easy. But is there something better? Is there something either simpler or more reliable? And so to answer that question, what we did was we went back to this quilt chart and we said, what are the things that are the most different from one another? And the things on this chart that are the most different from one another are small cap value and the S&P 500. And that makes sense. You got big things that are in favor, and you have little things that are out of favor. So they're polar opposites. They're very, very different. And they thrive under different economic conditions. And you can see that on the chart. When the S&P 500 is at the bottom, small cap value tends to be at the top, and vice versa. It goes back and forth. So what would happen if we combined those two things? We would still end up with a portfolio that's half in small, half in large, half in blend, half in value. So it sounds like it would be comparable. Well, this is what happens. You end up with a portfolio that has a slightly higher return than the US 4-fund portfolio, and it actually spends more time in the middle than the US 4-fund portfolio. And interested students, looking around, does anybody have a quizzical look on their face? May have noticed that the numbers on the US 4-fund changed. Remember, it used to be 100% in the middle, right? So why is it only 96% in the middle now? It's because it was displaced by the US 2 fund. So the comparison set changed. So the US 2 fund is now sometimes in the middle and pushing the 4 fund out. But really the headline is, whether you do it with 4 funds or you do it with 2 funds, it's pretty close to the same solution, right? You end up with 11.8% historical compound rate of return with the US 4 fund and 12.0% with the 2 fund. I'm not even sure that that's numerically significant. When you get down to it and you pick your funds, the fund choices will probably make as much of a difference or more than which of those 2 portfolios you choose to use. But the cool thing is you can have a portfolio that is diversified very, very broadly by just picking an S&P 500 and a small cap value fund. I think that's just amazing. Now, some of you are looking at that going, half of my money in small cap value, there's no way I could bear that, right? That sounds way too risky. So Daryl created another eye chart. I think this is in your handout. I hope it's in your handout because I know you can't read it. The thing that's cool about this eye chart, and we have lots of fine-tuning tables like this, is that it lets you explore what would happen if you went somewhere in between. So on the left-hand side of this chart is the full history from 1970 to 2024 of an all S&P 500 portfolio. And on the right-hand chart, you have a 100% small cap value portfolio. And in between, as you go across, you can see what happens as you shift 10% from the S&P 500 to the small cap value, or 20%, or 30%, and so forth, all the way across. So you don't have to pick a 50-50. You can be somewhere in between. And if we zoom in on the bottom of that, what you see is that on the left-hand side, you have the annualized return of the S&P 500 at 10.9%. If you shift just 10%, 1 penny out of every dime, into small cap value, you can get, historically, you would have gotten 0.4% more compound annual rate of return. That's pretty substantial. And if you look at the risk, and I'm going to focus on the very bottom of that, which is the worst drawdown, you go from a 51% worst drawdown, that's a peak to trough decline in the balance of your portfolio, to 51.6. Nobody'd notice, right? The difference between 51% drawdown and 51.6, they're both a bad day. I mean, they're both a bad day. That's not good. But whether it's 51 or 51.6, you wouldn't notice. But you might notice the money that you get from that extra 0.5%. And you can go to 20% or 30% or 40% and walk right on across the chart and see how much risk you're taking for how much reward you get. In fact, if you plotted the returns versus the standard deviation of all of those dots, that is the thing Joe was talking about earlier. That's the efficient frontier. So just to connect back to that. If anybody wanted to draw their own efficient frontier, there you go. You can do one with those two. So the other thing you can do with this table is you can go year by year or decade by decade, and you can look and see what's the behavioral price I have to pay to earn this greater return? Because there is a price, and that price is tracking error. So if you go back to 1970 to 79 and you look over on the right-hand side, the S&P 500 outperformed 3 years out of that decade. So if you adopted this strategy in 1970, you'd probably feel pretty smug, right? By the time you get to 1980, you're feeling like, hey, that worked out, nice. But if you went ahead to 1980 to 89, maybe not so much. It's hard to say, because you win the first part, you lose the second part. But the other thing you can do with this is going back to these percentages, so the 1970 set, you can look at the differences in the return for the 100%, which is what's shown over on the right-hand, your right-hand side. But then if you look at like the 1090, instead of it being a 5.4% difference in return, it's only 0.5% difference in return. So the more you commit to this idea of meaningful diversification, the more tracking error you're going to have to tolerate, and the more you're going to have to stomach these differences in the ride that you get. Now, the best thing you can do for this is to be like Rip Van Winkle. Look away. You don't have to. This last week, we had the wonderful opportunity. This is what makes retirement great. We had this opportunity to help our daughter, our youngest daughter, move to Eureka, to get established on her own. She's getting launched, yes. And her and her significant other needed some help. So I rented a truck. I was going to rent like a 16-foot. I ended up with a 26-foot long truck. And I had to drive it to Eureka on these narrow roads in San Francisco and over the Golden Gate Bridge, and I got hit by a car, and I mean, it was horrible. And the whole journey, every time I go over a bump, I'm listening to something rattle in the back of the truck, and I'm going, oh no, I hope that wasn't the TV, right? You're just hoping that you get there safe. And while I'm doing that, they're riding in the other car going, yeah, we packed the truck, it's gonna end up there, it's just fine. They're not worried at all. You don't have to ride in the truck. That's the point. You don't have to look every day at your portfolio and wonder what's going on. You can check every year or two, you know what I mean? You can be patient. And as you look away, what will happen is the ride will smooth. So the combination of diversification and a little bit of lack of attention on your part will both help you out. Let's see, where are we? So we just walked through these decades. These are in your chart. The 2000 to 2009 was great for small cap value. And as we'd already described, in recent years, the S&P 500 has been crushing it. Look at some of these differences, though, in tracking. What you'll notice as you look on the chart is that when the small cap value outperforms, it often outperforms by a lot. So it can lag for a while, and then it tends to catch up quickly and pass. So a lot of learnings in there. And I know that you have the data. You can go through it later. So I'm going to leave that with you. Just to drive home the point, and Joe kind of made this point for me earlier, these differences in the compound rates of return may sound small, but remember the rule of 72. So you take 72, you divide it by the difference in interest rate, and that'll tell you how long it takes you to double your money. So if you take 72 and divide it by a 2% difference in interest rate, that's 36. 36 years, you double your money with a 2% advantage in interest rate. A 1% interest rate advantage will double your money in 72 years. So these little differences across a lifetime, many of you are going to have the chance to invest for 40, 50, 60 years. They really, really add up. And you can see that in this chart that sums up the impact of a $10,000 investment going from 1970 to 2023. So the S&P 500 over that period of time produced a $2.4 million roughly result. If we look at the US 4 fund that we were talking about, it was $4.9 million. So 2.4 to 4.9, that's the kind of difference Joe was mentioning earlier. It's the difference that could maybe make it so you have more than enough in retirement to help your kids, help your grandkids, help charities. Or maybe if you didn't earn a lot during your lifetime, it's the difference that makes it so you live a comfortable retirement, right? The point is, it's a really, really substantial difference. So the 0.5% can mean millions of dollars. Will the future look like the past? I can't guarantee you anything about the future, but what I can tell you is that in the same way that I trust the weather in my area is going to be similar next year to what it was this year at the same time, I think the fundamentals of personal finance and human behavior are going to persist. So that means that although we don't know exactly what the premiums are going to be, the future will probably resemble the past. And the sequence of returns is going to be different. It'll be totally unknown. It'll be scrambled. But I do think we can learn from the past, and it can help us a lot. So conclusions. Number one, more diversification is good. And diversification just isn't about owning every stock in the stock market. It's about being exposed to these meaningful attributes that drive returns. So that's the size, the small parts of the market, the value parts of the market overall. And the additional asset classes may earn you extra premium, but they will definitely smooth the ride as well. And that smooth ride reduces the kind of risk that I think is most important to most of us in the room. A consistent set of returns, one that comes in more reliably, means a higher safe withdrawal rate. It means a lower chance of running out of money. It means a lower chance of being disappointed. And I think I have one bonus lesson in here. You are going to hear from people that the small cap value premium is dead. And it's not a hard story to tell. You can pick periods of time that say that the small cap value premium is dead. But if we just go back to an even number, year 2000, and we plot a variety of funds, we can kind of test this hypothesis. This is long after these supposed, or these premiums were discovered and published. And so some people say once they're published, they go away. They did not go away. The bottom line on this chart is a technology fund, FSPTX. The next line up on the chart is the S&P 500, VFIAX. The next line up on the chart is DFA's small cap value fund, DFSVX. And the next line up on the chart, the top line, is DFFVX, which is a small value core fund, I believe, from DFA. So the premium, not only has it not gone away, it's been very, very helpful for people who've stuck with it from 2000 to now. And with that, I think I can take some questions if we have any time. I don't know how we're doing on time. Does anybody have a question? Yes, over here.
Could you speak about adding in growth stocks and then also international, how that plays into the returns?
So the question is, could I speak about growth stocks and internationals? So the way I think of, I'll start with internationals. The way I think of internationals is that they're insurance against catastrophic risk in any one country. The United States is the envy of the world in many ways. We have very good protections of personal property rights. We have highly regulated financial systems. Because of that, we're the most expensive stock market in the world as well. There's no way to predict when Rome will fall, right? There's no way to predict when catastrophic things will happen to any one country. If you have your investments spread across multiple countries, you may or may not lower your return a little bit, but you definitely protect against catastrophic failure in one country. The other question about growth, though, I'll get to you in just a second. The question about growth. Growth, historically, it's like the opposite side of value. And so if you hold growth instead of blend and value, you get a rebalancing opportunity, which may help you out. But you also have a portfolio now that is tilted less towards value. And so you get less of the premium out of the portfolio. So that's why we construct our portfolios with blend rather than growth, is that we really want to get the exposure to the value portfolio or the value factor. Yeah. Woman in the blue, yes.
You're very knowledgeable, and I've been sort of visually mesmerized by these figures that flew across your screen. But I would like to make a suggestion. Looking around at the age of most of us in this room, we probably only have 10 to 20
Yep.
So I'm not interested in a 72-year.
That's totally fair. So it sounds like you guys maybe you couldn't hear it over there, but she's feeling like she's a little too old for the 72-year time frame. I get it. Yeah, point taken and appreciated, which is why I mentioned the consistency of the returns, because I think that that's important to people, even on a 1 or 5 year time frame. Did you have something else?
Yeah, for diversification of investment, why couldn't you just plug into a ETF?
Oh, you can.
Hey, Chris, can you repeat the question too, so people over here can hear what she asked?
Yes. So her second question is, why can't I just use an ETF? And the answer is you can. So on our website, we have a set of best-in-class recommendations for ETFs and mutual funds for each of these asset classes. So you could buy a large cap blend and a small cap value ETF and be good. Or you could buy large cap blend, small cap blend, large cap value, small cap value ETFs. And yep, you can definitely do it that way. Yeah.